Hi, my name is Corinne Wild and I'm an independent financial advisor at Three Counties. Investment bond taxation. This is not a straightforward area. If you are looking for information on investment bond taxation, perhaps because you are surrendering an investment bond, looking to make a withdrawal, or perhaps dealing with one which has matured because someone's passed away, this information will provide you with a high-level overview of how investment bond taxation works. However, it's likely to be appropriate to seek some professional advice, either from a financial advisor or a tax advisor. But in general, investment bonds are liable to income tax. So similarly to savings accounts, they are taxed at income tax rates of 0, 20, 40 and 45%. However, the way in which the tax is calculated feels a little bit more like capital gains tax. And that's because we actually look at the growth in value or the gain on the bond over the time it's been held. Now, the gain might still be held within the bond, or perhaps it may have been paid out in prior years as an income, but nevertheless, it will still form part of the equation when we look at how much tax there is to pay. Now, the way to work out the liability to tax for an investment bond is quite complicated. However, broadly speaking, we're looking at the growth over time and charging it to income tax. But if the bond has been held for many years, in some circumstances, it's possible to do an extra calculation called a top slicing calculation, which will allow the bond profit to be divided up between the number of years it's been held for. The reason we do that is to make sure that a bond that has been held for many years with a significant tax liability doesn't penalise someone for all becoming chargeable to tax in 1 year, when actually it's the growth of several years which is being charged to tax. It hasn't all happened since the 5th of April, for example. So it is possible to potentially help with the tax liability using top slicing, but this isn't a straightforward calculation. Again, get some advice on the best way in which to approach this. If you are looking to make a withdrawal from a bond, it might be that it's possible to make the withdrawal within a cumulative 5% tax deferred allowance. So this is another way of dealing with a bond from a tax perspective, which actually allows you to, instead of dealing with the tax liability there and then, defer it to a future point. Now, the future point at which the tax liability will become chargeable will depend on the circumstances of the bond. So if a bond life assured passes away, or if a chargeable event occurs in future years, or if the bond is sold for money on money's worth. But essentially, it is possible to delay a tax liability. It may not be, though, that this is the best course of action, because sometimes to deal with the tax liability in bite-sized chunks as you take withdrawals can give you a better tax result overall. Again, worth taking some advice on. Finally, the type of bond that you have is likely to dictate the overall liability to tax as well. Onshore bonds are treated as having had paid a 20% liability to income tax within the fund, whereas offshore bonds benefit from something called gross roll-up, which basically means that the bond has grown free of tax and the full tax liability will still be due. So whether the bond is onshore or offshore will also affect your tax result. Overall, it's just important to be aware that a bond can significantly influence your liability to income tax, especially if you are to surrender a bond that has a significant gain on it. So it is important to take some advice before you take action when it comes to surrendering a bond or making a withdrawal.